Have you ever checked the price for a trip abroad and noticed it's suddenly cheaper? Or maybe that new gadget you wanted, the one that's imported, just got more expensive? Well, that's the exchange rate in action. It's the constantly moving value of one currency versus another, and it pretty much affects everything we trade across borders. Understanding it is all about separating the daily noise from the long-term signal. So let's get into it.
Right, so why is this stuff always changing? One day the dollar's up, the next it's down. It can feel totally random, can't it? But as we're about to see, there's actually a method to the madness.
You see, the answer really lies in two completely different stories, and they're told on two different timelines. There's this fundamental long-run value for a currency, but in the short run, oh man, the market can get a little wild. It can overshoot or undershoot that fundamental path by a lot, which is exactly what this chart is showing us. Here's a great way to picture it. The long-run trend is kind of like a person taking a nice steady walk. But the short-run volatility, that's their super energetic dog darting all over the place, sometimes running way ahead, sometimes lagging behind, but always eventually coming back to its owner. These are the two speeds of money we need to get our heads around. And here is the crucial difference, what drives these two speeds. The long run, that steady walk, it's all about the real economy, the actual buying and selling of physical goods and services. But the short run, that hyperactive dog, that's driven by the incredibly fast trade of financial assets like stocks and bonds. Okay, so let's start with that slow, steady march. Over a period of years, a currency's value isn't random at all. It's really anchored to a country's core economic fundamentals, the real stuff. So this table breaks down the four big long-run drivers. First, if a country's prices go up, inflation, its currency tends to get weaker. Makes sense. If it gets more productive, its currency gets stronger. If people there start wanting more foreign goods, their home currency weakens. And then there's this weird one. If a country puts up trade barriers, its currency actually tends to get stronger. The big idea behind all of this is something called the law of one price. It's a really simple but powerful theory. It just says that an identical product, a t-shirt, a phone, whatever, should cost the same in New York as it does in Tokyo after you do the currency conversion. If it doesn't, well, something's out of whack. Okay, that sounds great in a textbook, right? But how on earth could you actually check this for a whole economy? Well, it turns out you can get a pretty good idea using something you've probably eaten dozens of times. Yup, meet the Big Mac Index. The folks at The Economist magazine realize that a Big Mac is pretty much the same everywhere in the world, so they use it as this fun, real-world way to measure the law of one price. They even have a name for it, burgeromics. Now check this out. Based on the price of a Big Mac, the Swiss franc looks overvalued. It costs more than it should compared to the dollar. On the other hand, the Mexican peso seems undervalued. It's a bargain. Now, this suggests that over the long run, market forces should eventually push these currencies back toward their Big Mac value. Okay, that's the slow and steady foundation. Now let's talk about the frenzy, the short run. This is where things get volatile. And this is where the financial markets completely take over. And when I say take over, I am not exaggerating at all. Get this, a mind-blowing 98% of all the currency trading that happens every single day has nothing to do with buying actual goods. It's all financial trading. That means only a tiny 2% is connected to that real economy we were just talking about. So on a day-to-day basis, the market couldn't care less about the price of a burger. What it cares about is where it can make money and fast. You've got investors slinging colossal sums of money all around the globe, chasing the highest returns they can find. So what are they looking for? It really boils down to two main things. First, which country is offering the best return on their cash through interest rates? And second, and this is a big one, where do they think the currency's value is going to go next? It's a huge global guessing game. But hold on, it's not just the interest rate you see in the headlines. Smart money looks at the real interest rate. And that's just the rate you're offered minus the rate of inflation. Why? Because what's the point of a high interest rate if inflation is just eating up all your profits, right? You gotta know your real return. And this chart just shows it perfectly. Look at the red line. That's the US real interest rates. And the blue line is the dollar's value. You can see it clear as day. When real interest rates shot up in the early 80s, money just flooded into the US, and the dollar went through the roof. And when they fell, the dollar followed right behind. It's an incredibly powerful link. Okay, so we've got the calm, long-run walker and the frantic, short-run dog. How do we connect them? How do these two totally different stories finally become one? And for that, we come right back to our first chart. That chaotic red line is the short-term market, right? Driven by interest rates and what everyone thinks is going to happen. It can overshoot, it can move way faster and further than the fundamentals say it should. But that steady blue line, that long-run path, it acts like a magnetic force. The market can get carried away for sure, but eventually, those deep, fundamental forces will always pull the currency back toward its true value. So, the next time you see a headline screaming about a currency soaring or crashing, you'll know exactly what to ask. Are you looking at the short-term noise from the frantic financial markets, or are you seeing a deep, long-term signal from the real economy? Now you have the tools to tell the difference.